Chris, you're just sort of big takeaway 2 months into the year, global markets, prices stuck in mid-80s, there's no wind in we're sort of the doldrums, if you like, in terms of where because you're a sailor, the parlance of wind, there's no wind in these markets. Your thoughts, will wind come?
Yeah, nice analogy. Thank you, Sean. Thank you, everyone, for making it here. 8 o'clock on a Tuesday morning is tough. Especially after, I think, a round of cocktails last night. But
this is the non-drinking crowd.
Yes, well done for making it. I think the year ended with a huge amount of apprehension in terms of both economic recovery, the dragon of inflation, and China still not opening up. I think in January we saw a fairly rapid change there. And since then, I don't think we've tamed the inflation tiger yet, but we've definitely seen Eastern demand improve a lot. And the forecast is, assuming no further untoward economic activity or more uncertainty geopolitically, then it's hard to imagine how we could have that. We see a decent recovery in demand through the course of the next year, in the form of 2+ million barrels of incremental demand year on year. So with that, we see the inventory builds that we've observed over the last few months starting to draw going into Q3. And on the back of that, with all the themes that are well spoken about already in terms of reinvestment slowing down, in terms of ongoing and incremental production, we see some potential for oil draws, which should be reflected in pricing.
But east of Suez, Chris, India is now the biggest, is it the biggest? It's close to being the biggest importer. 30% of Russian oil, or 30% of Russian oil into Asia is going to India. But nonetheless, all these new flows, and all of these dark, as it's called, dark fleets and pricing of Russian crude that nobody really knows about. Vitol, world's largest independent trader, operating in the not dark space. How did this emerge? It was one thing to have Venezuela and maybe Iran existing in a dark corridor of a somewhat uncertain economy of trade, but now you've got Russia moving into that space as well. My question to you is, what is the outlook for that? How does it distort, or does it distort the markets for traders like Vitol and your peer group?
Well, obviously, there is a massive distortion to the market, as Jorge says, that the grit. I mean, the West, in its wisdom, has tried to inflict a penalty, and one could argue that part of that penalty is obviously being borne by Russia, because they are having to move their oil at a discounted price to market, and that has hugely helped the countries outside the OECD who can take that oil. And yes, for us, it does distort the barrel. Obviously, the product derived from that oil, once it's been substantially transformed, is re-legitimized, as it will. So the penalty has been applied against the aggressor as defined, and it has helped the converter, be it India or be it China or be it some other Southeast Asian countries, which is material for them. Obviously, from a shipping point of view, a huge boon to shipping. Shipping rates have been exponential over the past year and hugely volatile depending on this ebb and flow of oil. For entities such as ourselves, we have to play by the rules, and we do play by the rules, and yes, there are huge dislocations, but we're seeing the rebalancing of that. And for example, we participate hugely in the US Gulf Coast export programs, and those remain hugely robust. So we try and facilitate global trade where we can, and that definitely has refocused our crude trading activity. But I take Jorge's point, and I think to some extent, Europe has suffered. I think Europe's been immensely saved by a very, very mild winter, which in June, July, August of last year, there was genuine concern in the market about how we were going to get through the winter. I think we're going to end the winter with decent inventory stocks, at least on gas, 30+% of reserves by the end of the winter, barring any unforeseen immediate imbalance coming up, but at current projections. So I think in light of what could have been a year ago, this time a year ago, when it was a few days into the invasion, everyone was trying to understand what would rebalance. Once again, the global marketplace has functioned, and surprisingly, to some extent, the pricing mechanisms forced by the West on this product has also worked.
What about, obviously you're chairman of Vivo, which is operating in Africa, 4,000 gas stations now. You're selling a lot of Mars bars now. New retail for Chris Bay. But the Africa clearly is it a beneficiary of this? Is it suffering? How is Africa being exposed? I mean, it's a lot of Russian products ending up in Africa. What's it look like?
I think anyone outside the OECD has benefited from what is otherwise the ability to bring in through the national government systems oil that is otherwise not able to get into more regulated or sanctioned markets versus unsanctioned markets. So yes, to some extent, Africa has benefited from this, and that has been helped the governments, in some cases, governments that have put in price controls in their countries to try and regulate the price of oil for the consumer, and ultimately against their balance sheet. So the ability for them to bring in oil at a cheaper price has helped them, and that has been an effect in Africa. As we know, Africa, along with other developing countries, emerging market, has been suffering from high prices, and so this is some temporary relief.
Well, we haven't mentioned the reopening of China, and I wanted to get your thoughts on that. 2 months in, we've been through this sort of euphoric phase. Oh my God, China's reopening, sell everything, buy everything, But nonetheless, China reopening it doesn't appear to be the major game changer that maybe the optimism in the markets a few weeks ago. Your thoughts on it, how it's going to play out the year ahead? What's Vitol thinking?
I think as we know, I mean, this has been a massive 2-year shutdown. Aside from the trade issues that China is facing, just the logistics issues of coming back. We've seen that probably most notably in the airline business is just getting international travel back into the market has been incredibly difficult because planes get laid up. So I think we're fairly new into that. I mean, the opening up just started before Chinese New Year. We're less than a month into it. I think we'll see that progress over the next few months, and that certainly leading into Q3 is going to be one of the engines that drive demand going forward. So
does it go back? I mean, as you think about China going forward, is it it springs back to what it was, or like we're hearing, after the war things will be possibly different after China's shutdown? Is the world not a little bit different? China's the massive demand for EVs, mobility is moving very quickly to electric. The supply chain is at least it was talking very seriously about diversifying, get into India with Apple and other things. China's not going back to being the big energy consumer it was.
I think in terms of percentage growth rates, but remember we're dealing with China with 8 to 10% growth rates a year for years on end. Now, whether that goes from 8% down to 3 or 4%, we're still talking about relative to rest of world growth. We're still talking about growth
OECD average.
OECD average. We're still talking about growth potential. So it's not. I don't think it goes back to pre-war levels or pre-trade tension levels, because obviously there is a huge shift in manufacturing back into the West. We're talking about here in Europe and the US, how do we bring battery manufacturing, how do we bring industry back into the more regional economies, which is a trend which probably will continue. But there's still potential, we think, that China will the opening up of China the very rapid opening up of China still hasn't been fully felt by the market. So I think that is to come.
Everybody, every session I've been to in this only 2 days of it's the first, second day, has said the exact same thing. I would short that. What do you think?
Well, it's this conference and other conferences tends to be game changers. But no, I mean, listen, we deal with the events as we see them.
Yeah.
I think the world is a complicated place. I think China supplying Russia with arms, also trying to declare a peace treaty. I don't know, maybe someone here in the room has a view. Saudi Arabia making a visit into Ukraine yesterday, which seems contrary to some of the political moves that they've had leading up to that visit vis-a-vis Russia. So I think we're living in a very complicated world. East of Suez again, you've got, yes, the Modi government, but rapid change in India, and you know, how is that change built? I'm referring to the Adani situation.
Yeah.
So, you know, it is a very complicated world, and to Jorge's point, we've created a lot of distortions in the market, which have provided a lot of grit. The question is, who's benefiting from that and who's suffering from that? I would argue to some extent that despite a lot of skepticism, these pricing limitations have worked, because the consequences is that, for better or for worse, Russia has not been able to sell its products fungibly in the market, in an open market, in a transparent system, which has led to distortions. You have less liquidity in the market because of price imbalances. So the transparency around pricing, the ability to manifest the price, is also a lot more complicated, because there's huge reticence to go in and price risk manage in the market, existing market structures that happen because of margin postings, liquidity constraints, variation margin constraints. Everyone is a little bit nervous. So yeah, I think what that to me tends to indicate, and we've had a fairly stable price range over the past 3 months, is that volatility is going to come back.
Oh, it's going to come back. Anybody want a quick question before we wrap up the session? Yeah, please.
Thanks so much, and thanks, gents, for your being so on form at 8 o'clock in the morning. I did want to ask Chris, so I'm a reporter, I cover commodities traders. You know, looking at East of Suez markets over the past, is it 5, 10, however many years, we've had high economic growth in Asian economies, we've had low interest rates, and relatively low pricing of products for traders to be able to sort of move fairly easily and simply around the world. Not simply, but, you know, what do you think, I guess my question is, of this new era where we're going to have high interest rates, potentially more volatility in the markets and higher pricing, does that change the business model for, I guess, big traders, but maybe smaller traders in these markets?
Access to capital, I suppose.
Yeah, I think it's the perennial problem in terms of liquidity and cost of capital, and right now liquidity is limited and capital is expensive. So what it means is that if you're going to want to operate in the market, you just need higher margins to cover your operating base. And I think it does become more difficult. I think for larger regulated traders that operate in the public markets, the activities are going to be much more restrained than some smaller entrepreneurial traders that seem to be sprung up overnight, seemingly, that are going to be able to do to move oil that we would not touch for obvious reasons. So I think there's two changes there. One is, yes, liquidity and cost of capital obviously is going to make trade more complicated because it's more expensive, and B, you're competing on a very uneven playing field in terms of your opportunity set.
Zakulas from Amaris Risk Management, thank you very much. Following up about the new companies that emerge in the East, would there be the case that behind some of these companies could be Russian interests? So in the end, part of this trade is again being absorbed by Russia itself. And one from Mr. Bake, would you envision a period that escalation has risen that much between Russia and the US, something that we see now, that even secondary sanctions could be on the table?
I think the answer is to the first question is by all means that the very nature of the dark trade and emerging trading entities that are possibly thinly capitalized. I think in the medium term, there's one thing is to take advantage of an immediate short-term opportunity set, which clearly they are. Medium term, how they transform that into a sustainable entity that eventually, if they want to operate in a more regular market, especially against an exchange or with a wider set of banking channels, that will get regularized. So I don't think it's the beginning of the end by any means yet, because I think we're still in very early days around this opportunity set. In terms of secondary sanctions, I think, as you know, the product price cap is fairly new in terms of placement, and how that actually pans out, I think time will tell. And I think the geopolitics with the Middle East and Asia all sort of weighing in on the Russia equation, not only Europe and the US, I think that will also evolve. So I don't have an immediate view on secondary sanctions at this point, but it's clear that the pressure is going to continue to mount on all sides to find some kind of resolution or try and bring this to
But
a
on
head.
that point of secondary sanctions, I mean, ultimately, they don't want the oil to be disrupted, right? So secondary sanctions is not being enforced.
Well, I mean, I don't know if you call these sanctions secondary or primary, but the sanctions are being enforced, but the implementers of those sanctions have determined that the cost to the global economy, and we saw that last summer, to Jorge's point, when we saw the effect on fertilizers and foods, was severe. So what has been tried to do is navigate a narrow road where there is so-called punishment to the aggressor, but the benefit does get into the global economy, and if we restricted outright the oil, that would have very adverse effects for the global economy. So we're trying to thread the needle.